Thanks for joining us today, guys. Today we are joined by Andy Wang. He's got a great story and to share with us in terms of family business, personal investment. So without further ado, Andy, you want to introduce yourself to the audience?
My pleasure. Thanks for having me on the show. Yeah, my name is Andy Wang. I'm a managing partner at Runnymede Capital Management. We're a fee-only registered investment advisor, helping families and individuals to manage their portfolios, do some financial planning. And I also host the Inspired Money podcast.
Excellent. So as a investment advisor, essentially managing money for high net worth people, companies, is that kind of the thought process?
Yeah, that's the gist. We work with some nonprofit organizations also. In the past, we've managed some pension fund accounts, but for the most part, it's individuals and families helping people to plan for retirement, manage their nest egg, protect and grow their nest egg while they're in retirement. And then working with some younger people too, just, trying to get their financial planning set and on course so that they have a plan to follow in the years ahead.
So very much an expert in the investment space and what to do with profit. So excited to hear your thoughts. The jumping right in, the question we like to ask is, once you reach that point of profitability, you don't have to worry about roof over your head, food on the table. What's the framework or the structure that you thought through once you hit that point? You had mentioned that, Runnymede is family-owned business, family-operated business, right? So I'm sure there were some trajectories there, where ups and downs and different crises, et cetera. But, once you hit that point, how did you guys think about where to invest the money and, where did it go at, early on?
Well, what I love about investing generally is that there's not a right or wrong way to do it, in that there are so many ways to skin the cat, so to speak. I listened to some of your prior episodes. You had like commodity investors, you have real estate investors, and we're coming at it from the angle of more growth stocks, buying them at the right price. As you said, it's a family-run business. My father, Sam, started Runnymede Capital in 1993. So it's been a good run that we've had, and it's nice having the two sons as a legacy story. How do we continue with the business for the next generation? And I would say that our investment philosophy kind of plays into what my views are on investing my personal portfolio. And my father was the director of research at the Bank of New York through the 1970s. He was one of the youngest senior vice presidents in the history of the bank at age 28. He ran the research department, visited hundreds of companies in that time, had about 200 banks subscribing to the bank's research, really as an independent source, of visiting companies, writing company reports. Most of those institutions were other banks. But my father really enjoyed that, like as an academic exercise. He got to go around talking to senior management of big companies, asking them, how do you make money? How are you successful? What is your 3-year, 5-year, 10-year growth plan? And then from there, he ran the bank's money management subsidiary, Beacon Capital. So he was managing the bank's pension fund as well as outside accounts. And then, immigrant's dream to own his own business after 20 plus years in a big organization. He realized his dream before age 50. He's like, I've got to do it now or finish out my career at the bank, and decided that he'd take that leap. So given his expertise in research, it was always about how do you manage risk? And coming at it from a, stock investing perspective, there are so many ways to manage risk. One is at the company level. So we're strong believers that earnings matter. So we look at things like, what is the earnings growth? We look for companies that have steady earnings growth, because at the simplest level, if a company is profitable and making money, the stock price should follow over time. There should be a correlation there. Beyond that, we'll look at company management. Where did they come from? Were they promoted from within the company? Did they come from outside? How familiar are they with the history of the company as far as, what is driving growth? And then try to understand what are the future prospects. So for us, it's like, one, you want to own quality companies, and that comes down to earnings. Two, diversification across different sectors and industries. And then three, you manage risk by, we use a weather analogy frequently. You look out the window, there are times when the sun's shining, and there are other times when there are storm clouds on the horizon. And we feel like there are times, this bucks convention a little bit, because my industry likes to say, just weather the storm. The academic studies show that if you just commit to a investment strategy and you stick to it, that in the end, you come out ahead. And I think that there is truth to that, but the complexity is that if you're retired, you don't have a paycheck coming in anymore. You really can't take the same risk that you were taking when you were 20 years old. So we think it is important to, look at major market cycles and try to make an assessment. Like, where are we in the market cycle? Is the sun out, or is there a risk of a storm? If there's a risk of a financial hurricane, my feeling is that it's okay to sometimes board up your windows and evacuate if you need to. When the sun comes out, then you're ready to go again. But there are times when you should be investing aggressively, and there are times when you should be protecting what you have. I think that that's important.
What's your 30-second synopsis of where we are in that major market, right?
Where are we right now?
Are there hurricanes coming towards the New Jersey shores, or are we, still making hay because it's sunny outside?
The $64,000 question. I think that this year gets really interesting. I mean, not to downplay a global pandemic over the last 2 years, that's been crazy. But where we are today, I think that, many people were surprised at how resilient the stock market has been in the face of COVID and lockdowns and really shutting down economies in the US and across the world. But you had all this liquidity in the system because the Federal Reserve, the European Central Bank, the Bank of Japan, all the major central banks around the world lowered interest rates so low that there's just so much money in the system that it helped to support financial markets and keep things going. Where are we today? The Fed says that they're going to be hiking rates, and the stock market's actually factoring in at this moment 5 to 7 rate hikes in 2022. In my opinion, that's a lot. I would have liked to have seen the Fed start raising rates a year ago when you still had economic growth. The risk right now is that the Fed is planning to raise interest rates, which makes stocks less attractive on a valuation basis. And they're doing that in what will likely be slowing growth. It's a little bit different this time, right? That's always the challenge. Oh, this time's different. The stock market usually has a correction either when you have a recession or when interest rates are rising. And in this case, there's no recession. You just have a deceleration of growth. But decelerating growth, this is GDP growth for the US, from 7% growth to 2% growth, probably in the second quarter. I think that deceleration, plus with rising rates, we've already seen it since January 1st. Volatility's up. I think risk is rising and not falling. So at our firm, we have been raising some cash in client accounts, and we want to have that sort of dry powder, so to speak, so that we can take advantage of volatility and buy at lower prices. So that's our view.
Makes sense. We're heavily involved in the real estate space, obviously, right? And I've been trying to communicate to a lot of our agents and clients that hey, we're either at the top of the market or we're not far off from it either way. As you see, interest rates are starting to rise, affordability concerns are there, supply, constraints are there, and you're starting to see that there's some signs that things are slowing. And it's like, as you were mentioning, all the indicators at the macro level point to some sort of correction, or at a minimum, a slowdown that will occur, because people just can't continue on the pace that we're seeing with the inflation and the market, right? And so it'll be fascinating to see what happens. I got burned, from a theoretical perspective, we should have seen that slowdown or correction at the start of the pandemic. But to your point, the liquidity, and it's like, I neglected to remember that we can just pump money in and keep things right. And so the reaction they had was amazing to keep it where it's at. I think a lot of lessons learned over the last, couple corrections to keep it from a massive change. But something's it can't continue, right? Like, you can't keep printing money and have inflation and still have it work. So,
well, we talk to a lot of clients and a lot of people, and there's always this wall of worry. There are always concerns. And, I know many clients who have been worried since, I don't know, I guess when it comes to political affiliation, it depends, like whichever president is coming in, if you're on the other side, they're very worried. And, all of that has proved not to be, it wasn't a concern that is worthy of raising cash or changing your portfolio position. And I think that this one is interesting in that I don't expect, and this of course, I'm looking into a crystal ball that doesn't exist, right? So let that be the disclosure. But I think that I don't expect this to be like a financial crisis or internet bubble, something of that magnitude. That's not what I'm expecting. But I do think that hiking rates, just the timing is not great. Hiking rates into slowing growth, to have a 20% correction would just be normal and probably healthy for the market. And, with the probability of that scenario rising and not falling, I'd rather have some dry powder. But yeah, I'm just trying to make the point that I don't think that it would be as severe as a 2008. But who has a crystal ball out there? I'm all ears.
Yeah, likewise, right? To your point about the disclaimer, right? It's like, I don't know what's going to happen in the future. This is just my personal opinion. Take it as you see fit, right? I want to go back. So you were talking a little bit about kind of how you guys evaluate, looking at companies, right? Looking at the earnings, right? Looking at the management. As you guys started to become profitable in the early days, did you guys invest alongside kind of clients' money in the same sort of strategy? Was that something that you felt compelled to do, to say like, hey, our money's in the same place, right? Or did you take and diversify? Kind of, what was your thought process there?
For me, I think that, well, I'm going to be forthright and say that I'll provide an example of things that you shouldn't do. I would say that I'm guilty of being, it's like the son of the shoe cobbler, and we spent all our time managing client accounts and we don't pay attention, or we don't pay enough attention to our own accounts. And that's a lesson learned. Looking back with the benefit of like hindsight's 2020, yeah, we should be invested alongside our clients because we're doing the work, we're doing the research, both on individual companies as well as where are we in the market cycle, and we should benefit from that research. There were many years where I didn't do that, and I think that it's easy when you're in the business, not just investment business, when you're in your own business, you're so involved with the day-to-day, you don't take the time to take care of yourself. And I think that that's important. You do need to take a step back or earmark the time. It's easier said than done, but you need to do it because you need to be strategic and intentional for your own future as a business owner. And I think that I could have done that earlier, right? They always say that your money has two best friends. That's time and the power of compounding. So time is very important. The earlier you start, the better off you're likely to be. And I know that for me, I missed out on some time. I could have been having my personal portfolio better invested. And as you said, for me, that would be alongside with my clients because I've seen my clients' accounts grow over time. And I'm a little bit envious. I wish that I had realized the same, growth over time, because time is on your side if you're investing. If you're going to be a long-term investor, the longer you have to let your money grow, it is very significant.
How does that, as you look back now in hindsight being 2020 and you have that perspective, how has that changed? Are you now invested alongside? Do you take more, like, what were those steps or awareness that you had to kind of come to get you to where you are today?
Well, since it's a family business, I feel like you're never really off the clock because you're having Thanksgiving dinner and you're still talking about work. You're like having a business meeting over turkey, which is fine. I mean, we reap the benefits too, right? I'm not saying that as a negative, but I think in some of those discussions, we're very open about the fact, we have the benefit of periodically looking across our client accounts, and you see, because not everybody has the same investment objective. There are those who are younger and can take more risk. There are those who are retired. Maybe it's a nonprofit organization. They want to take less risk. They want to grow their accounts, more conservatively. And we have the benefit of kind of looking across the accounts to see who has done the best, what has worked, what didn't work. Interestingly, there are many clients who they hire us because they don't want to look at their investment portfolios day to day. They want to outsource it. They want an expert to handle it for them. And I would say, generalizing, the accounts where clients don't interfere much tend to do well. And the reason is investing is like, it is like growing a tree or watching grass grow. Like you can't interfere and make the grass grow faster. If you have a investment discipline and you have an approach, an underlying philosophy, then you just have to stick with it and give it some time. And of course, in the real world, you have clients who are calling because they're worried about Russia and the Ukraine, or they're worried about who just was elected president. And some of those interferences just disturb the portfolio unnecessarily. And you make some moves that are counterproductive. So I think that it is important that, for me, we're having conversations in our family, and it's like, you know what? We need to just invest our money like our clients and stick with it. And then that way, as fee only advisors, we already feel like our incentives are on the side of our clients because we're not being paid a commission based on any specific product. There's not a potential conflict of interest where we're trying to recommend one fund or one product because it pays us more. That's not the case. We charge a management fee. So it's in our best interest to grow our clients' accounts and to protect their accounts depending on what's happening in the financial markets. And we want to be invested alongside with them. We want to own the same stocks or exchange traded funds and let them grow and, do our best not to. It's like behavioral. Don't interfere because you can't make the grass grow faster.
It's like you're essentially what you're alluding to is if you can remove all the emotion and leave it as a purely logical, structured decision, the structured decisions tend to do better than those that have emotional interference, essentially,
I think that's
whether it's
true.
fear-based or, wherever that comes from.
For the most part, that holds true, I think, when it comes to money. When it comes to money, it's usually fear and greed that's the driving motivation for all of us. And when it's based on fear or greed, that emotion usually is throwing you off from doing the right things, right? Just the timing tends to not be good. Those emotions just come at the wrong time,
Yeah.
usually.
Yeah. And when you said family business, your mom is involved as well. Is that right?
Oh yeah.
So your whole immediate family unit is in the business. I mean, what was that like kind of going through that? I mean, that's got to be, to your point, the Thanksgiving dinners, and it's like, is this a work meeting or a family meeting, right? Like, that's probably a lot more integrated and tighter than a lot of people have. And so, what was that experience like for you? Or is it
Overall,
like, right? Because it's still
overall,
going.
yeah, it's still going. Overall, it's been great. And my dad's been slowly stepping back from the business and letting me and my brother really manage the client accounts and direct like, where is Runnymede Capital going as a company? To his credit, I think that can be rare in family businesses. There are so many cases where you hear about the family head who doesn't want to let go of the reins, and there's this conflict between generations, and it gets pretty hairy because there are all kinds of family business sort of groups, and you hear a lot of the challenges that I think are common to family businesses. For the most part, I think that we've done well to manage those things. We work well together, and maybe we're lucky that I feel like each of us has like different strengths and weaknesses, and they don't always overlap, which provides us the opportunity to kind of figure out who is in what role. And then that works out better because we're not stepping on each other's toes all the time. Division of labor is clear in that sense. And I think that's important for any small business.
As we're nearing the end of time here and starting to wrap up, Andy, what's one of the, if you were to leave one piece of advice or one thing to think about, right, for people who are coming into profitability or thinking about what to do with their money, what would you share with them?
The most important thing is to set a plan, because if you use the analogy like you're going to drive across country, you need to map it out. Today, we have the benefit of Waze or Google Maps on our phone. So kind of we forget about maps, but still you need to have, whether you have like an app that is helping to guide your way and reroute you when there's an accident or traffic. I think the same thing needs to be done with your money. As your business grows and suddenly you have some investable funds, it's good to set a plan to really, take time to think about, when is it that you want to retire? When is it that you want to get out of your business? Is there going to be a point where you want to sell your business or pass it on to somebody else? And at that point, what is it that you want to do? Right? We don't always think about these things. Like, where do we want to live? What kind of life do we want to have? What are the things that are going to be important to you once you're no longer in the day-to-day running your business? Because thinking about those things and planning it out, it does give you some insights. And I think that planning does matter. Planning can help you to get to where you're going, so that you're not just driving randomly. That's not good.
So for someone who says, great, I want a plan, how do they start that? Like, it can be daunting to think like, hey, I want to get to here. Do they need to start with a number and work backwards? Do they work, forward? Like, what's the first step that they take in terms of go plan?
I think it varies individual to individual. Definitely there's going to be the number side, but I think it has to start away from the numbers. It's like, what do you and your spouse want to be doing in retirement? And do you have children? Do you want to be near your kids? Do you want to be spending more time with your kids? Are there grandkids? Like it's just clearly setting what are your priorities, what matters to you. And then from there, then you take a look and say, all right, well, what moves are going to be required? Are you going to be selling your house and moving to another state? Are you going to be traveling in retirement? And then definitely you need to take a look at the numbers. It's like, do you have the finances to make all those things happen? And if not, how much time do you have between now and the future to make some changes to get there?
That's great. For our audience who wants to connect back with you, Andy, what's the best way for them to get in touch or be able to find you?
The best place is, should I give you two? I'm going to give you two, but they go to the same place.
Two works. Yep.
Runnymede.com. That's Runnymede Capital Management's website. But if Runnymede is too hard to spell, put inspiredmoney.fm, because you'll see the Inspired Money show, but all goes to the same website. So you will find me, and I welcome the opportunity to hear from any of your listeners and send me an email. Happy to communicate with you, even if you don't want to open up an account. If you have any questions or feedback, I'd love to hear from you.
Awesome. Appreciate your time today, Andy.
Thanks so much. Appreciate it.